US CPI comes in hot and triggers a break higher in gold and the dollar. Equities shrug it off and remain pinned into OPEX this week. And China's stocks show signs of bottoming as the second derivative improves on a number of fronts. All this and more in this week's Macro Insight. Okay, so welcome back to Macro Insight, everyone. Today is the 16th of November. Welcome to any new trialers, and let's take a look at these markets. Last week, what did we have? Really, it was all about the CPI, right? So the CPI in the US printed higher than expectations, and that just sent the two-year bond yields surging higher and catalyzing a break higher in the dollar. All right, so we've got, the main movers. We had like a 3 sigma plus move, obviously, on the US 2-year. We had break-even inflation spiking as well, 2.5 sigma up move. And then obviously gold breaking out along with some of the other rates markets, right? So those are like your main movers on the upside. On the downside, obviously, we had Tesla pulling back pretty hard after the news of Elon's selling shares. I think he sold around about 7 billion over the week. And whilst it didn't really crush the market on the Monday, on the Tuesday, the market was down pretty significantly. I think the shares were down about 12% that day. As you guys know, I had done an iron condor that looked incredible after day one. Didn't look so good after day two, but I managed to get out of that one for not too much damage. So that's the whole point of these iron condors. You're selling vol, you think it's expensive. The odds are, you collect your premium, but the reason for owning those wings is that in an unforeseen event, you don't lose your shirt, basically, right? It's trying to make that risk reward of selling volatility much safer. That's why we do those trades that involve owning those wings. What else? So yeah, the move in gold, the breakout in gold really was about, initially we saw obviously break-evens spiking higher, inflation break-evens, and then the yield curve was actually flattening initially. As we have been seeing, when the front end yields spike, the back end doesn't really spike so much, or might even go a bit lower. And we did kind of start to see that as soon as that CPI came out, and the real yield swinging down into the minus 1.2 area helped really trigger that gold rally. And we got the technical breakout of that big level we've been talking about at 1835 in gold. But basically, the other stuff really that's going on, and partly, some of this rate volatility that we're seeing, is there seems to be a shift away in the way the US administration views Fed policy. So whereas before, they generally want the Fed to be accommodative and stimulative, the problem now is that with Biden's approval rating plummeting down to like 41%, he's getting a lot of heat for all the inflation that Americans are actually feeling, right? From grocery store to pump, they're feeling these higher prices. And so he's now outright saying that inflation is a main priority to get that under control. So, whilst he's saying that, and then people are now saying, well, Brainard is becoming more likely to come in as the new Fed chair, which apparently is going to be announced this week or next week before Thanksgiving, but that doesn't really marry up, because she's arguably more dovish than Powell. So if the administration wants the Fed to be a bit more hawkish and get inflation under control, not really hard to tell what's going to happen there, right? And I just think that uncertainty is triggering these wild swings in the rates market, and that's what we're kind of seeing, right? Bond markets don't really know where to go. And then you've obviously had, the recent Fed scandals with PA trading. Powell could arguably be, used as a bit of a scapegoat to deflect some of this criticism away from the Democrats. So there's arguments to say that they just might kind of get rid of him as a signaling, look, we're going to change things up, right? So, there's a lot of uncertainty around that, and markets are going to be watching it closely. And then with fiscal policy is obviously being watered down pressure on the Fed to potentially get inflation under control, about 2.5 hikes being priced in now for next year, the odds of a policy error are definitely rising, right? So, don't be surprised to see more flattening of the yield curve going down the line. Obviously, lately, there's been a bit of steepening over the last sort of week or so. But me personally, I'm still thinking the long-term US Treasuries are an own. The auctions weren't great last week, and that's why we probably saw a bit of pressure in the long end of the curve. But I own some call spreads, as you guys know, on TLT. I'm quite happy with that position. This doesn't expire till March next year. If I was going to do anything with that position, it would probably be buy back the short leg of that call spread at some point, just to leave me with a naked call. It's a bit early probably to do that now, given there's still a fair amount of premium on that short call. But that's kind of what I'm thinking. I'm certainly not doing anything with that trade. I think that's a good one to have parked in the book into next year. And then despite the recent rates moves, you've got Morgan Stanley economists saying that they think there's going to be no hike until 2023. So they're completely going against the 2.5 hikes that are priced into the market. Bit of a bold call, but that's what they're saying. Some of that might be due to the fact that we're starting to see signs that supply bottlenecks might be easing. So yeah, that's been the big problem, right? These supply chain bottlenecks that have been driving inflation. It's not really necessarily all demand side. The supply disruptions are the issue, right? So got a few charts up here. So you can see coal and iron ore prices are absolutely collapsing, right? So for China PPI, these are a bit of a lead indicator, and they've rolled over. So whilst we're still seeing quite high prints coming out of China PPI, obviously it's a little bit lagging, that data, you are starting to see these things turn south quite dramatically, which may then feed into that. If you look at the container rates, you've had a lot of disruption there. Prices have gone up by probably 10x, since early last year. Those have started to show signs of rolling over. And then the Baltic Dry Index as well, rolling over quite dramatically, right? So a few of these things that are showing us what's going on in terms of moving goods around, maybe these are starting to ease, and then some of those commodity prices rolling over. We also know that lumber's rolled over as well, quite dramatically from the highs that it's seen. So a few of those, potentially those leading commodities, showing some signs of turning south. Yeah, which means that inflation, whilst we're seeing very high inflation prints now, these might be the kind of peakish levels that we're going to see. And actually going forward, things are going to come back down again, right? And, central banks are notorious at acting at the end of, the cycle, just as it's turning back the other way. And then they do things to combat it, and it ends up being the wrong thing to do, right? So that's something we need to watch out for. What else? Sentiment continues to roll over. So we had obviously University of Michigan sentiment out on Friday in the US, and it doesn't really paint a very pretty picture. So sentiment rolling over. I mean, that goes back 20 years, that chart, and we are pretty low, right? We haven't seen these type of readings on consumer sentiment for, about 8 years, right? So, conditions for buying properties, conditions for buying cars, all these things are looking pretty dire right now. So it's basically just showing that, you've got prices impacting consumers and consumer sentiment. Obviously, cost of living rising, house prices have been high. You've had a fair amount of psychological damage from the pandemic restrictions. You've got vaccine mandates that are making people quit their jobs, general job dissatisfaction, loss of faith in the government. Just a lot of stuff going on right now that isn't good for sentiment. And, if anything, sentiment is a bit of a lead indicator on consumer spending and stuff like that. And then these animal spirits that have kind of helped pump markets, given this sentiment backdrop, could be quite fragile at the first sign of trouble. So whilst, people have thrown a load of money into chasing stocks, if stocks start to stop performing, then that there could be a bit of a flush out there. So given that sentiment isn't great in general, right? So something to watch out for there. So where is the S&P? What's it been doing? So obviously that was over the last week or so, we were banging up against well, we managed to push just over 4,700, had a bit of a pullback on that CPI, managed to hold the support level down at 46.20. That was the kind of vol trigger level down there. And now we've banged up back against the 4,700 area. So it seems that the big strike in terms of where all the gamma is on the S&P is 4,700 right now. That's what the guys at Spot Gamma are saying. And, we've got the expiry this Friday. So, historically, or we had been seeing over previous months, a bit of a sell-off into expiry. Didn't really get that in October in any meaningful way. But the previous expiries before that, we had these sell-offs. To me, I think, the gamma pin seems to be quite strong around this 4,700 area for this week, given that the market has kind of gravitated back towards it, despite what's happened last week with rates volatility being quite high. Equity just kind of shrugged it off. Dollar strength often is a bit bearish for risk assets. Market didn't care. So I'm kind of putting some of that down to the idea that this S&P gamma is sucking us back up to that 47 area. Okay. That mean reversion, I think, is partly explainable by that positioning. Okay. Also, single digit realized volatility as well. And the anticipation of more selling smashed the VIX back down, right? So you had a momentary spike in the VIX. This is an hourly chart, right? So within 3 hours, the VIX went from 17 to 20, and it got slammed straight back down to 16 handle, right? So it didn't manage to stay there for very long. Suggests that either vol sellers came in or the anticipation of more vol sellers for this week, because we've got an expiry week, which normally you get a load of vol selling. That brought the VIX back down. So, those are kind of generally quite bullish indications that the street is not wanting for volatility right now, right? The street is long vol, probably a load of gamma on the Novembers, and is likely going to get sold a load more December vol this week if they haven't already got it. Okay. And that's going to make it relatively hard for the market to move down in any meaningful way. Okay. Unless you get some major shock that the market isn't expecting. The volatility trigger on the downside that they're calling for now is around that sort of 46.40 area. But the way I'm kind of playing this pin this week, as subscribers know, is I did an iron condor on S&P, fairly sort of low risk trade, the 46.50, 46.75 put spread against the 47.25, 47.50 call spread, selling both those to collect around 11 index points. So the trade can make 11 or lose 14. So it's quite close to even money to play the pin. To play the pinning effect into the 47 strike, basically, right? So that's kind of how I played that. And we've got most of the earnings are out the way. The US macro data is pretty light this week. It's mainly UK macro data we've got. So I think that gravitational force of that 47 is quite likely to play out. So I think the odds of that are quite high. Yeah, so that's why I've played it. In terms of sector dispersion last week, you had consumer discretionary and energy lagging. You had utilities and retail leading the pack. But in general, you've had broader participation in the market, right? So breadth indicators that were rolling over a couple of months ago as the only thing that was rallying was tech have rolled back up quite significantly. And you're seeing much broader participation in the rally that we've seen of late. And then gold, we obviously got to talk about gold. Finally, long-awaited breakout in gold that all the gold bugs have been waiting for. We've been saying that I think gold has really suffered from the fact that crypto has got a lot of inflows that would have ordinarily gone into gold. We can see that on the chart on the left where we've got all the sort of Bitcoin funds versus gold ETFs. And you can see that sort of from middle of the year that those gold ETFs have just been reducing exposure. And Bitcoin obviously had that massive inflow. Sorry, that was from middle of last year, not middle of this year. But now on the chart on the right, you can see gold after breaking that big level we had talked about, 1835, having a bit of a catch-up move. But compared to where 10-year real yields are and how strong that correlation has been in the past, there's arguably room to get as high as 2,000, right? If you really want to catch up to where real yields are. So, could this break in gold have triggered that move? For sure. Let's see if it can gain some momentum. It looks pretty healthy. I mean, the fact that crypto's down today is probably helping gold as well. If crypto stays under pressure and doesn't rally, then I think that will generally help this gold narrative. Like I said, I think 2,000 as a year-end target, if this move really does want to close, if that gap wants to close, then that's your obvious sort of target, I would say, right? The way to play it, I personally wouldn't go too short dated on the calls in gold. I prefer, because the term structure in gold isn't very steep. So you're not having to pay up very much to buy slightly longer dated options that buy you more time. So I would be thinking that to get leverage to an upside spike in gold, I'd rather own lower delta March calls than lower delta December calls, right? So that's kind of my logic. And like I say, the logic is based on the idea that the term structure isn't very steep. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.